it worked. So it's definitely Facebook. It's streaming on YouTube. So let's get going, guys. All right. Welcome, everybody, to live at Zoom and YouTube, which is supposed to be Facebook Live, but Facebook doesn't want to play today. So we'll do it on our own here. Now we're going to talk about learning option strategies with chart patterns. That's what Dan and I do every single day. And we find chart patterns, which we're going to share with you on how we do it. And then we're going to go through the process. Well, first we'll explain the process as to how we come up with these through the scanning software that I use. And of course, you can just click through charts endlessly, in your interest list, but go using a scanner like what I'm going to show you. And there's lots of scanners out there. This is my personal preference on the one that I use, and how I set it up to scan for these setups. And it works really well. It cuts down the work time, and then Dan and I go at it and go through those lists that we come up with and find where the money lies. And it's easier some days than others.
Hey, I like that.
Sure. Right?
And Greg, you actually said an excellent statement in our pre-market review and preparation in the Master Trader Green trading room today. And that was, look, today's gap down, yesterday's gap reversal. We need more information. And we didn't have enough information at the market close yesterday or this morning for directional trades. And so that's the perfect, lead in that what we're talking about, because at Master Trader, everything starts with a bias, a top-down analysis using the Techno-Fundamental approach. And if we aren't in a full bullish or bearish directional mode, the option income trades we find all the time.
Yeah.
So we're looking for the money all the time.
Right. And that's really the beauty part of it, because my whole time as an investor, a trader, focus has been directional strategies.
Right.
And, in a choppy market, there's very few directional strategies, and most of them that you come up with, they're just not that good. And when they do come up, they tend to all come up at the same time. So what do you do in between? You have a tendency to press the envelope, meaning finding a trade that will produce the money. And that is not the professional way to do it, of course. So, when Dan and I started working more together, well, Dan and I have been working together almost, 25 years now, 20-some years.
Yep.
But Dan's primary focus has been options, and mine has been trading the underlying, whether it was futures, ETFs, stocks, of course. And, us working together just opened up another vehicle as to how to make money. And
particularly because we have done a phenomenal job of integrating the two approaches.
Absolutely.
To have the best approach, in our opinion, of course, we're biased,
right.
But trading options with a directional bias. And we know that there's some other educators out there who don't believe in charts, and they just look at the math. And, we can point out endless examples of where they get run over with that inability to believe and learn chart analysis.
Absolutely. And, and that's a whole nother subject, of course, as to what they're doing. But from my point of view, being a directional trader and investor is one in which there's not, you can't say there's no stress, but the less stress is trying to find those patterns that are more X-ray, into the moment as to the entry point.
Right.
Whereas we look at stuff and, I look at it and say, well, this is a mess.
Right.
That's perfect.
Mess is good for many of our strategies.
Right. So, as we go through this, you guys will see that we're just coming up with chart patterns that say prices aren't going to go one place or the other, or maybe neither. Right. That's what we're going to focus on in part today. They're going nowhere.
Consolidation. Yeah.
And then finding the ones that Dan has coined as having some juice.
And then, in addition to our search for the money in these choppy non-directionals, putting all that aside, we still find great trading ideas every market open because of the gap plays. Like one today was a Grub, GRUB. It was a professional gap breakout. It could have been a directional and income trade. But yeah, I mean, I have a whole list of gappers today, and that's one of our strategies in the middle of earnings season. But
yeah.
we have,
and today's market being as erratic as it was, and I looked at it after it hit my stop, was that CHKP, I think it was.
right. Yes.
And I mean, it whipped down and then whipped back up again. And that's kind of what the market's been doing. Just kind of very erratic. And but that one looked great. But gap trading, that's another subject.
Right. So we have a lot of slides just kind of to go through here, educational, give you the background, give you a couple of examples. And then, we all, as always, want to save some time to do some live scanning so we can, watch Greg in action, what he does being an incredible scanner. But also, since we're here looking for the money, we're going to do it real time together. So let's begin and go through a little bit of this coursework. So we're going to be talking about selling these credit spreads, which we call an income trade, not a directional. And we're putting money in our pocket just to call a short-term top or bottom. Once we're in a trade, we're in trade management mode. It's that simple. So we're just going to, in particular, talk about one adjustment strategy at Master Trader, which is legging into this iron condor. So let's begin and get some of this textbook background stuff out. We keep it simple. What are the only movements of stock? They can go up, they can go down, they can go sideways. So what we're doing in selling credit spreads is we look for a short-term top or bottom, and we're going to sell a bull put credit spread under support. So what does that mean? We're going to find a bullish bottom, any type of reversal pattern, or pull back in an uptrend. We're going to sell an out of the money put, and then buy a further out of the money put just to make it a lower risk trade and less capital intensive. And we're putting money in our pocket that's ours to keep as long as the stock goes up, chops around sideways, and because of the premium we put in our pocket, it can even go against us. And that's what we refer to as our cushion to be wrong. And if you're trading stocks alone, you have zero cushion. If it goes up or down a penny, your open P&L is going to change. So that's the beauty. What we do on bullish patterns, bearish patterns, we do the exact opposite. We're going to sell an out of the money call spread. And the cushion is again, it's our profit potential and ability to let it go against us, which is a beautiful thing. So we're kind of acting like an insurance company that sells policies over and over again. They collect money, and then they're going to have to pay out some claims every now and then, but that's why this is 85 to 90% successful. We don't claim they're 100% successful. When the pattern fails, we stop out. We take our small loss and move on to the next setup. But today, I'm going to show you in these examples how we're going to massage the position because of our changed bias, and that's going to increase the probability of the trade working in our favor. These, or Greg, why don't you tell them about these? You're the technical master.
These are the pictures, right? And we like to keep it simple, not make it complicated, and that's why I use the term pictures. Right? We're just looking for a picture that suggests a reversal of some type. They come in many different types. So we don't subscribe to teaching people to memorize dark cloud covers and haramis and, morning stars and shooting stars and so on and so forth. It's like, does it look like it's turning around? And those are the different pictures that say it's turning around. So that's our starting point.
Right. And then we just put them in multiple time frames. Yes, Carl, yes, we are showing on the charts. Yes.
You should see a slide, Carl, not the chart yet.
Oh, yeah, yeah. We're going over our PowerPoints.
You may have to just log in and out of the room.
All right, so these are the pictures we're looking for. Now, here's what a bull put credit spread is. We're going to sell this under support, our put. We're going to buy a further out of the money put. We're going to put it in as one order. This is called a bullish vertical spread. And then that money we receive is our potential maximum profit if it expires worthless. And we're just going to manage in between. Now, these
Carl
are just
said he could see me though, Dan. I said that was the most important thing.
yeah, we got a comedian on our hands today. Okay. We don't care about the names. These are just two recent trades of ours among hundreds. Spiders on the, and we love selling credit spreads around ETFs because they're less gappy, of course. On the left, spiders in July, just earlier this month, we had a big sell-off. It's building. Look at that bottom, red, green. So there's still a fight going on, but it's on major support, a prior low, rising 200 moving average. As soon as it broke out of that base, our confidence said that those lows are going to hold. So we sell an out of the money put spread, and as long as it goes up like it did, chops around, or the short strike price, less the premium we took in our pocket, that's our cushion to be wrong. So it can go against us. The IYT on the right is just the transports ETF. And same thing. It was building this choppy base after a climactic buy setup on major support, right there at the rising 200. We had a lot of volume washing out, the bear positions, new buyers stepping up. Same thing. We sold a way out of the money put spread that could have gone against us $11.50. And we still made $700 on a 10 lot. So, I mean, Greg and I find these all the time, and they're easy to find, they're easy to manage, and they have extremely high profit potential. That's batting the success rate. Hence,
Dan, I something that just came to mind while you're talking about that is that sometimes it's so easy that, like I was talking today, actually pre-market, about not becoming complacent about, certain things, the routine of, reinforcing your method and how I did that. But I'm thinking to myself, sometimes I do become a little complacent because at times it's so easy to find setups.
right?
And, sometimes I have to force myself to go to different scans, because when it gets difficult like that, I do have different types of scans to look for, of course, but
I mean, you and I always like talking, the psychology, what are the messages behind, bars and patterns and internals and fading market sentiment, et cetera. So my question to you is, what message do you get in this circumstance that you're describing?
Well, when I don't find things like snapping fast like that, and then I start looking more and more, I come to a belief that, well, it's just not out there. And I probably will find, I just have to continue to do the work.
But isn't that the market telling you that they aren't in alignment?
Yes.
Like, for example, these two charts we're showing right now, they were just a couple weeks ago. We probably did overwhelm our subscribers, but we could have overwhelmed them a whole lot more, because on this breakout, on both these trades, there were hundreds of stocks doing the same thing, which is one reason why we just focused on so many ETFs. And that was an easy time. So when the things line up, I believe in the 80-20 principle in trading also, that when we are ready to strike, when things line up, you should, use whatever analogy you want, hit the accelerator, take on bigger, share size, more risk, because you're going to get paid during those times.
Yeah. And I think, look, when we do get to the scanner, I will find the patterns. But one of the things that, if those that are new to options trading is that, and what we're talking about here today is that there's two elements to it. There's the charts and there's the options. So finding a chart doesn't necessarily mean the options are going to be offering the opportunity. So I guess the frustration for myself is I'll find the chart. That's not a problem. But the juice may not be there. And so that's the extra work with it. But when you find it, they tend to be many of these what we call high probability, no brainer kind of trades.
Correct. And just for the new people, so master trader, Greg and I have been trading, decades, but we provide different services. We can teach you how to fish, as the analogy goes, through our seminars, our stock and option seminars. Or if you don't want to learn how to fish, but you would like to learn over time with the setups and the trade recommendations, because we always give our reasons for making a recommendation, then our various advisory letters do that. Our main advisory letter, we trade stocks and options on all time frames, give incredible market review. And then our weekly options trader is just focused on one specific area, selling options and spreads with 10 days expiration or less. And I mean, people love both of them. So, that was just a little background if you weren't aware of those. All right, let's continue, because I want to get through these slides and then do our scanning. Let's find some money patterns.
We'll get to the good stuff.
Yeah, I'm still looking at Grub. What a beast that was today. This is just totally the opposite of the bullish one. So we're finding bearish turning patterns. We're going to sell an out of the money call over resistance, buy a further out of the money call to make it a bear call credit spread. We're going to put money in our pocket as long as the stock goes down, sideways, or it can even go up to our break-even point, and we still make money. But we use stop outs. We can talk about it right now of the different strategies. So we're now in a trade. How do we manage it? We're always managing per our bias on it. So let's just talk about adjusting and rolling strategies, because that's the main focus. So using options, I always think of the DJ who has the music panel at the disco, and he's tweaking various buttons. And that's the beautiful thing on options, that day by day we have more information, and as long as the pattern's fine and we're in trade management mode, we can still tweak it to generate more money with our bias. As long as the underlying pattern has not been negated, meaning the reasons that we entered the trade, either bullish or bearish turning point, has failed, then we stay in it and we just try to massage the most amount of money that we can get out of the short credit spread. So we're going to add or adjust. You can roll based upon if it's going against you a little bit, or hey, this thing's working better than I imagined, so I want some rolling techniques that is going to give me a bigger paycheck. Now, we can't get into all of that today, obviously, but we get into all of these management style strategies in great details in our option seminars. First example, and these are real trades of ours. That's why it's so easy for me to give you hundreds of examples, but these were the ones on today's subject. Start with a pattern. What is our pattern here? Well, it had a very bearish gap down. It looks like May 1, rallied up to resistance, double top, and then a nasty another breakdown. So is this a directional trade? Would we want to short stock or a directional option trade? The answer is no. But would we like to put money in our pocket for saying this isn't going above 60? So that is our bear call credit spread. You know, we teach you in our course, we have I'll tell you about later, our mastering advanced credit spreads that we teach you exactly the setups, exactly which strike prices to sell, how many days to expiration, and how to manage them. But this is the trade.
They know what you said, days to expiration. And with that symbol there, DTE, is Dan is saying days to expiration, 25 days. So
Right.
with these spreads, depending on the market environment and the stock, sometimes you find them with 5 days, 10 days, which kind of makes them closer to a no-brainer. Meaning, so when you're looking at that chart, and Dan, I say, well, what do you think about it going over $60? And he says 25 days. I'm like, probably not. What about, you think it'll go over $60 tomorrow? No, you can have this money if you take that trade.
But the more days to expiration, obviously, similar to an insurance company selling you a 1 week car policy or a 1 year, it's going to cost you different. So right. That's part of the analysis that we teach you. And, you said we go all the way down to 5, 3, 2 days, whatever. We also specialize in selling options on expiration day, 0 days to expiration. There's some Greek traders out there who, like to scare you on this, of this unknown risk from the Greek called gamma, but that's because they don't know how to read charts. So yes, if you are not a chart reader, gamma is the thorn in your side. If you know how to read charts and trade our methodology, it's a payday. We get paid for calling short-term tops and bottom on day of expiration. The Spiders, SPY, S&P 500 ETF, has multiple expirations each week. So that is one of our go-tos, not only in our weekly options trader, but our green room.
Dan, here's in the other chat, Leo said ATVI bull credit spread question next week expiration. So I bring up the chart and I look at it.
Okay.
And what do you think the first thing is that I see? Because Leo's probably seeing that there's some juice there.
Earnings.
And I haven't looked. Absolutely.
Right. So say we're conditioned if the premium is too good to be true, that it's either earnings or there's a pending major news event that is going to move that stock one way or another. That's why those premiums are that high.
Right. So we can look at this when you're done with the slides, but
absolutely.
This has weekly options in it that are going to expire in 2 days or 9 days, but it's a bullish pattern. Like it's going to go up.
Yep. Let's look at it when we're done with this. So yeah, let me kind of speed up here because I want to save time for scanning. Full profit, we're in the trade, is 80 cents a share. So on a 10 lot, which represents 1,000 shares of the underlying stock, that's $800 in our pocket. ROC is return on capital. I take that 80 cents a share, I divide it by the maintenance requirement of $4.20 a share, 19% return on my capital. We're in the trade. Here's my next page 2. I'm in trade management mode. Has my bias changed? Well, you can see by my my icon there, we're like, oh no, this we have a bearish position. Now it's a deep retracement that just traded over a prior pivot of resistance. What did we do? We're still okay with our original position, but we're legging into an iron condor. What is an iron condor? It's short and out of the money bull put spread, out of the money bear call spread. So our bias is range bound, and we're getting paid twice now. So we sold this one for 75 cents a share. That's another 750 bucks. What's my break even? And where do I want this stock to go? Well, you take your $60 short call, you add the total 160 a share premium that we put in our pocket, and that's where I get 61.60. What's my lower break even? My 52.50 put that I sold, and see the green line? The put is way out of the money. I have huge cushion for this stock to stay in, and I still make my maximum gain. So it's the 52.50 less the 160 I put in my pocket. Slide 3. It looks like it's working like a champ. We're still in trade management mode. And just in this small discussion that we've had here now for 33 minutes, ask yourself the following question. Is there any reason to do anything different on this iron condor wide range bound stock? Answer it yourself. To us, the answer was no, we didn't do a thing, except through time decay, which means when people buy options, that costs money. You have to pay for that. And there's other reasons of what calculates the total premium price, volatility, days to expiration, et cetera. But my point is, it's a depleting asset. Day by day, what the decay of that option price is to the option buyer is our profit. So as long as this thing just chops around like this, we're making money day by day, whereas the option buyers are losing money. I have another question here for you. Is this a good pattern? Because this is where it expired, worthless. I grabbed the chart all the way to expiration. Is this another good setup based on what you've learned so far? Answer, yes. We have defined areas of resistance, defined areas of support. Example 2, another trade of ours, SBAC. We started out with another bear call credit spread. With that, the most recent big green bar, and then the very next ugly red bar breakdown, under the low of that, we said this stock's not going above 162.5. And actually, I gave you the wrong strikes there. We actually sold this a whole lot higher on the strike prices. It was like 165, but it doesn't matter. Same analysis here. So full profit if it expires below that, 11% return on capital. Now, slide 2. Has our bias changed? You better believe it's changed. We thought it was going to continue down or just chop around sideways, but it took out the high. So what did we do? Bar by bar, we're adjusting our bias. So on that bar that it's pointed to, we sold an out-of-the-money put spread. Took in another $700. We stopped out on our call spread, just keeping the put spread. So we actually lost 50 cents a share on the call spread, but we made full profit of the 700 on the put spread. So by legging into this iron condor, we converted a losing trade into a winning trade. So Greg, why don't you say a few words about this beautiful stick figure?
That looks like a trading range.
Absolutely. So what do we do on trading ranges? We can trade stock or options, but today we're talking about the option strategy. And whenever we get a reversal bar at resistance in a trading range, we're going to sell an out-of-the-money call spread. And then we're going to do the reverse once we get a bullish reversal on the put side. Now,
there's a lot of details there, Dan, that may not be appreciated just by the conversation of the options, but those bars, the way you've drawn them, put them in, and this is, you know, an example of exactly what we look for, is that those topping tails are little mini breakout failures, and that reversal down at the bottom are little breakdown failures, and they're very powerful.
Absolutely.
The way, you know, we use the candles with the options, and you know, where they communicate to us these pictures, that where buyers are taking control and vice versa, and how it happens. So it gives us the ability to get in near the turn because of that analysis. So you may think, well, you know, by the where the topping tails formed, I could sell the credit spread down below the bottom there. Well, you're not likely to find that free lunch. So getting in near the turn is where they're going to be those premiums. So yeah, you do have to take a little bit more risk, but based on the analysis, the odds are in our favor, and that's what we're looking for.
Right. And Carl is asking, so is the key to an iron condor to leg into it? Excellent question. And everything starts, and actually my next slide is going to answer that in more detail. We don't touch the mouse on our computer to enter a trade unless we have a bias on the chart, and then we put on the proper trade to match our bias. 97% of the time, we have a bias, whether it's the bullish side or bearish side. You know, 90, what I'm making up 97, but the vast majority. So to master trader, we prefer legging into them, correct. But the very next slide here, and the quiz that I asked you back on STX, asking you, was that a good candidate to put on an iron condor at the outset? And that's what I'm answering for you right now. We will put on an iron condor at the outset under very special circumstances like this. It has to be a wide, defined trading range where you have clear resistance pivots, clear support pivots, and then we sell the credit spreads, and it has to satisfy our test of juice, of sufficient premium to warrant the risk. And then we just manage in between. So just like my DJ guy adjusting bias, if this turns more bullish, we might add some bullish positions, maybe reduce the bearish positions, and vice versa. But you also see here what I typed. Flat major moving averages like this is a plus. And Greg is the master of, you know, teaching technical analysis, and right. We don't believe in oscillators. We do believe in simple moving averages because it speeds up the process. Now, do I need these moving averages to make a decision of this being a good candidate? No.
You know what,
it's a plus. It's a plus.
Yeah, let me share something with them based on what I was saying about, you know, my past always looking for directionals. So this chart, if I was teaching you directional strategies, this would be an example of don't go near this. You see those moving averages intersecting the middle of the prices? That's a picture of stay away, move on to something else. Whereas for option strategies, it's a good picture.
Absolutely.
It's directionless and what we're looking for.
Right. So yeah, so STX and this are good examples where you can do an iron condor, as the heading of the slide says, at the outset. All right, good. Just a quick word here on this course I told you about, and then let's jump into scanning. So mastering advanced credit spreads. Again, we're going to show you how to pick the right patterns, the right strike prices, the right days to expiration. We're putting money in our pocket on these turning points that we've just went over. It's a great way to generate weekly and monthly income. How to manage these, I'm just sharing with you one strategy today on management. We'll get into that in much more detail. It's 12 comprehensive modules and with specialty topics. This took me over a year to put this material together. An entire module on trading volatility ETFs, how to trade earnings like we did today on Grub. And I had a whole list of them, both before and after earnings. Gaps, news, trading ETFs, trading on expiration day. So we've just launched this like 2 months ago, and we have phenomenal testimonials. People are loving it. So go to mastertrader.com/mastering spreads, and you can just highlight over each module, or left click it rather, and get a detailed description of each. All right, Greg, so why don't you take over and let's start finding some money patterns that we can possibly trade today, and or put it in our watch list for the coming days.
All right, first I'm going to go through and find, this was the one that Leo had mentioned. Let me get the controls here. And move this up.
Yeah, even the spiders are back to looking great right now.
Do you know why, Dan?
Tell me. The option traders again?
The wrong way option traders. I told everybody this morning. I mean, things got whippy. But
tell them, elaborate on that.
Option traders that bet on the market's direction, when they get on the same side of the boat, it ain't going to happen 99% of the time. So yesterday, when the market gapped up, they all jumped on the call side. I'm like, this is bad. The market couldn't, after 10:30, it couldn't go up it couldn't attempt to go up anymore, and sold off. So this morning, it opened up kind of flattish, went down, and as it started going down, I said in the chat room, which we call the green room, I said, okay, wrong way, guys. They're starting to lean on the put side. This is a good sign. I don't know where it's at right now. I could tell you. Before we broke, was it about, well, here it's at 0.97, but earlier this little blue line was close to, and it flips up and down because it's a live thing, but it's a daily chart. It was up near 1.2, close to it. And that was a great sign that, the market is not going to drop, not in a big way, not for them. But anyway.
And I wasn't here at the moment, but today's Wednesday, which is a expiration date on the spiders, as I alluded to earlier. I should have been thinking about selling a spider put that expired today, and I just went in front of the computer then.
All right, so you could see, I just turned it to an intraday time frame, so you could actually see where it was. So this is something that we share in the room on a daily basis because we're focused on intraday. And you could see right there, well, we can expand this a little bit when we get the other thing. Right here, as the market sells off, and earlier, those option traders start buying a lot of puts. And that helps to put a floor under the market.
Perfect.
As well as the fact that, the trend is still up. But let's get to our scans.
And the opposite happened yesterday. We had the bullish gap up, and they were buying too many call options, and that messed up the bullish side yesterday.
All right. So what is great is the market gaps up, and they start betting that it's going to go down. That's a great setup because the market will continue to go up. But right, just great. I've been tracking that for decades, and it's human nature. They're never going to be on the right side. They're all leaning one way. It just doesn't happen. All right. So this is the one Leo was asking about with a bull put credit spread, because it's got a nice pullback pattern toward minor support, rising moving averages, and a reversal today. So part of the issue is the fact that it's going to report earnings. That's what this date is right here on the 2nd. So there tends to be more premium. So when we look at the options table, which I'll drag over here, you should be able to see. So when we talk about a put spread, we want to sell them away. So let's say 7 to 75 strike, because this could poke under these lows here. So 75 seemed to be a no-brainer, that it shouldn't go down there based on that pattern. But earnings clearly throw a different, screw it into the mix. So for a 75, well, this isn't on, didn't switch for some reason. Hold on. What was the symbol? A?
ATVI. AT.
Yeah. Okay. So now here we go. So if we say $75, well, for 2 days, it's 2 cents by 4 cents. Nobody's going to do that. How close do you want to get to it? You want to bet that it won't go to 78 for 2 days? Maybe 30 cents. Or, you start going further out, and now you start getting into where the premiums are.
Because earnings.
The earnings. So do you want to take on the earnings risk?
Yet another one of our subscribers today, as you know, asked about Guild. Had a same thing, a beautiful daily, weekly, but earnings coming up.
All right, so you can't say that it's wrong to do it. It's more of what I say is a personal choice as to whether you want to take that risk. And kind of like call it, do you feel a lucky punk trade? In a sense, it's like, people do stuff and hit home runs and they go broke too. How many times can you take a hit? So
and the rationale of the people who just sell options into earnings is they just have an assumption that the options are overpriced, and you could look at the option price and it just calculates right on the platform for you. I use Thinkorswim, and it'll say the expected move is $6.40, whatever the case. And those people say, well, it's not going to gap more than $6.40. So they sell calls and puts, hoping that it'll stay within that boundary. And you either, like Greg said, you either get lucky or you don't. But I can point to hundreds of examples where you got run over by a freight train.
Yeah. If you did look, Dan, what was the expected move on Google when it reported?
It was right around $50. I did look. And so that one, it gapped up $55. So that one, depending on how you manage the trade, is whether you're a winner or loser.
We have a student, or at least a follower in YouTube, says the void is more important than the expected move.
Absolutely. So they have good proper training.
Good point there. And for those of you that don't know what a void is, you all know what the meaning of a void is, but I used the term putting together many years ago to educate those that, hey, if there's no support and no resistance, odds are the prices are going to trend. And the foundation of price movement is based on supply and demand, where there is resistance and support. And if there isn't any, there's a void. And the odds are that prices will trend. But that's a whole nother, webinar that we could do on a live day. But let's look at some other So
yeah, since we're, kind of, just look for any bullish pattern and let's see if we can either do a
well,
credit spread
here
or
you go.
direction.
Someone in there mentioned 3M, and this is the process. So we look at that and say, do I think that there's a setup here that it won't go one way or the other?
And I would say, yes, I like the pattern I like is a very bearish gap down that was negated. So I like it. And so it had earnings today. So I know that it was on my list.
Yesterday.
And so we love selling options on earnings within the first couple of hours of the market open, because the volatility from earnings and the subsequent reaction to the stock once the market opens keeps the volatility high. So when it's high, we get to sell these options for a juicy higher price. So if we could sell, I'm just eyeballing it over here, like a 192 or lower put spread, then I like it. For me to do a directional trade, it's rallied right to resistance. But if it could go sideways for a couple of days and then break out, I would consider that for a put spread and a directional. But
so again, this is a good example, meaning it's a choice. How close do you want to get? How much money are you willing to take or tie up?
Let's talk about it.
So there's nothing for 2 days. Now, the no-brainer would be at the 190 strike.
Right. So
that's the no-brainer. So for 9 days, it's 15 cents by 22 cents.
Correct.
Right there. Now, I don't think it would probably not go below 195. That's 41 cents by 47 cents.
Right.
So now, if you took that and used, even the 185s, right, you've got, right, what is that, like a dime, 30 something, 35 cents maybe for 9 days.
Right.
Right. So 10 lot, $350 for 9 days of risk that it won't go to $195.
And so since you brought up the discussion, and this is exactly how Greg and I, bat around our thinking to come up with a recommendation for our subscribers. But when we teach our subscribers how to fish, they see what we're doing, so they can pick their own expiration, their own strike. So here's another idea for us, Greg. Going all the way out to August, which is 23 days to expiration, but we could do the 192.5. So that gives us another $2.50 of cushion for the stock to go against us. And if we do a $7.50 wide, the midpoint right now is 53 cents. So on a 10 lot, that's $530. So that's what the market's offering. And then Greg and I have to look at the chart, look at the broader markets, look how confident we are on it, and then we make a go, no-go decision for our subscribers. But this is the process we go through.
So,
and that's not bad.
It's not bad. So 192.5 is way down there.
Right.
What's the likelihood of it going down there? It would seem relatively small. Right. Now, I go down to a smaller time frame. I say, well, I'm going to start getting nervous if it goes below 198, but it could poke underneath there. But the 192.5 does seem like a no-brainer, even for 20-something days.
And those are the trades we're looking for, where Greg and I both say, it looks like a no-brainer. Does that mean it can't go against us and we stop out? Of course that can happen, but we're just basing our analysis on what's happening in the moment. And then, as I talked about on an earlier slide, we're in trade management mode at that point in time. And because of the time decay, this is one of my favorite sayings in selling options, and our students and subscribers love saying it too. The stock went against me and I still made money. Yeah. And here's the reason why. 23 days to expiration. Let's say we stop out of this in 10 days. Depending on where we stop out, if it goes against us, it still could be at a big profit because of the time decay that I mentioned. Number one, that's referred to as theta in the Greek world. And number two, volatility contraction post earnings. We're making money from Vega, which is volatility coming down. So yeah, I like that trade. And I also have UTX on my radar for a way out of the money put spread.
That's
in fact.
So there was a comment in one of the chats about this staying in the upper 50%. So again, he knows he's a student, or he knows definitely what we're talking here.
Right.
So what we're looking for with a wide range bar like that is that it does stay in the upper 50%. Now, what I would say, this particular pattern, which says this is put in a low, and this could be a directional type of play, possibly. What we'd want to see here for maybe, what I would like to see for another couple of days, that this stay right up here in the upper 25% of here, and then break out above the highs.
And let me add one more thing. So yeah, I said the same thing a few minutes ago, but if it then goes sideways for 2-3 days on an hourly chart, which is one time frame below what we use, it will then build what I like calling, a launching pad. So then we could not only suggest a directional, but we can also suggest a put spread under that hourly major support. So we would get paid a lot more because the strike prices are going to be a whole lot tighter.
Right. I think we're giving too much here, Dan, today.
I was thinking the same thing.
Yeah, but we love doing this.
I was thinking the same thing at that exact moment.
Yeah, I'm in trouble. But look at the bottoming tail bar there on the weekly. I mean, this is a nice setup here, potentially for a core trade. So we'll keep an eye on this. And while I'm even thinking about it right now, I'm just going to set an alert.
I agree.
Well, yeah, why not?
Kind of a similar type of earnings trade, but it happened on 2 days instead of one, was our Philip Morris, Papa Mike. And we just sold a naked put on that, and we're already at 70% of max profit, or 80. And that's because of what I said earlier, time decay and volatility contraction.
It's a similar pattern. And it's not exact, and it doesn't have to be.
Correct.
It's the idea of the event. What happened in that event within the context of the chart?
Right.
And it said, hey, it's not going back down there. What other one did you want to look at, Dan? Someone said ALB for a
UTX I have on my radar. Yeah, ALB, but yeah, no, keep that one up there for a second. ALB,
that's got earnings next week. I think next week.
Okay, but yeah, that's
2 weeks. I mean, this is the process chart.
Well, Greg, show them Delta Papa Zulu. We entered yesterday. Yeah. And that, folks, bear in mind, was in a bullish market. Wow. We shorted and out of the money. Go ahead, Greg.
I found this in the scan yesterday. I forget which scan it was, but obviously it was in a weak scan. And I was like, yeah, the market was bullish at the time. I was like, this is not going back up. Because it was showing relative weakness. And then the market got weaker and, it was working. It is working.
Right.
So here, just to go through the scan, which said we scan, and this scan here looks for basing. And what it's looking for is basing in 2 time frames. I'm looking for the daily to be going sideways and the weekly to be going sideways. So in essence, sloppy mess going back and forth for the most part. And then you start going through them. And so you could see sideways. And now it's like, are there events here and when I say event, I really mean like some type of failure within the base, a shock. And there's nothing here that really jumps out at me as saying like, hey,
Nothing.
this is a no-brainer. It's
Right.
not. It's
Right.
not. So we move on. So just because it's in a scan, it doesn't mean it's a trade. Not only do you have to look at the details, which is what we do, right? And then you go to the options table if it meets the details of the pattern. Right? Here's another one. That's not a no-brainer. And it's going to report, well, a couple of weeks, but it is bottoming. But it's pretty messy. Those check marks there tell me whether it's above or below certain moving averages. RF, nope. Well, I know there wouldn't be any premium below $17 because lower
Right.
price ones just tend not to have it, and it's a bank,
Correct.
you know. This one has possibilities, but it's a lower price one, and earnings are probably maybe today if they either came out or tonight.
Right. And just as we're going through a couple of these more before we end, since we're talking, we also talked about whether to do a iron condor out of the gate or leg into them. So notice on this weekly chart really is what I'm looking at.
Mm-hmm.
There's much more area of support than there is resistance. So this is not a good iron condor candidate. It's a put spread candidate. And then if it starts weakening more, then we could leg into a condor.
All right. So just I'm sure everybody understands what Dan said, because that was a good point for, just saying, on a real quick and dirty way of doing analysis, so to speak, is just saying, hey, here's your resistance and here's your support. Which one has better odds of holding? Well, the bigger one. Well, it's a good point. It doesn't take, you don't need any, we don't use indicators. There's a couple of moving averages. So we teach, and what we do is not to use indicators. Get them off the chart. It could lead to confusion. Just look at the chart and common sense. Is it going up, down, or sideways? And if it's going sideways, look at the events. Are the events bigger? There's a shakeout. Than the other side.
Greg, I was just thinking, and I don't mean this sarcastic or whatever, I mean it very seriously. The way we teach that basic, what you just said right there, what immediately popped into my head is that we literally could teach this to a 7-year-old.
Yeah.
Who can look at a chart and say, yeah, that's strong and it's going up, and be smarter than a broker who's just a salesman trying to get you into something that their firm tells them to sell.
Or one of the hundreds, if not thousands, of indicator salesmen that want to tell you, hey, you can make money if you buy my indicators.
Absolutely.
Right. Or you can make money by drawing lines up and down a chart, by connecting dots, the way I like to say it. There is so much misinformation out there about using technical analysis that just leads to a bottomless dark hole pit of confusion and losing money.
Yeah.
On indicators, Fibonacci analysis, Elliott waves, drawing trend lines. If those of you that are listening here, whatever you do, just take that thought, be open-minded about it, because I know you're inundated with that garbage as to indicators and lines and waves and so on. And it all seems convincing in the moment because you're seeing things being shown after the fact. And I'm saying they're getting a headache just hearing that, because that person knows they've already gotten beyond the hocus pocus indicator mythology and all that garbage that's out there. And when you hear the statistics of why 90% of the people fail in this business, it's because of that. Because they're just being led down the wrong path.
Do you remember just last week, Greg? Greg, I did a live little lesson from an email subscriber. Well, I don't even know if he is a subscriber, but he said, hey, on my MACD or RSI, whatever, it's overbought and it's at resistance. The RSI was at resistance, not the stock. And I pulled up the daily, weekly, monthly, and I'm like, oh my God, there's nothing bearish on this stock whatsoever. And, you know, I did a live recording and sent him a copy of the recording, and the stock, you know, just ripped from there.
Yeah. Yeah. It's, you know, look, I'm not saying that it's easy to do this, because you have to learn a method. You have to use it to get experience. It's like any else that you would do. You know, go to school for something, get experience doing it, gain confidence in yourself that you can execute whatever it is that you've learned. You know, be an accountant, be a lawyer, you know, be a public speaker. I've learned how to do it. I know the theory. Now I'm practicing it. Now I know I'm freaking good at it. You know? And, you know, that's what it's about. But when you start putting the squiggly lines all over your chart and start connecting dots, and you start having lines on top of lines, you're going nowhere, right? And you just move to the next webinar where the next guy is trying to sell you his indicator package or how to draw lines. And in there many years ago trying to figure it out. Well, there were no webinars when I started, so I'm showing my age. There was no internet. But anyway, there was still the indicator mythology out there, and that is not the path that I believe you should take, because this is so much simpler. I mean, what Dan and I are showing you here, this kind of stuff, you're getting it already, you know. So the education part puts it all the little pieces together, and then, you know, you just have to do it. It's like anything else, right? You just do it. So.
All right.
And by the way, guys, those of you that join our green room, if you take the course and join our green room, if you use this platform, which for an end of day analysis for credit spreads, you don't even need intraday data. So it's like $29 a month. I have no association with them, but I've used this charting software for an extremely long time. It's the best scanning thing out there that's relatively simple to put together scans, but I'll give you these scans for free. Not free for sense, but, you know, by joining with us, take the course, join the room. If you just join the room, I'll give you the intraday scans, of course, because like I've said to our subscribers there, I want you looking at what we're looking at, because more eyeballs are better for finding opportunities. Right? So,
yep.
You know, you just email me through this platform. I send you an email back. You click it and it pops into your scanner or your charting here in 1 second.
Awesome.
It's awesome. I mean, you know, Dan, it's the truth. I just click on this and go to this thing that they call TC Mail, and I just link my layouts into that. And when it gets to the other side, you click it and it loads exactly what you're seeing.
Well, nice.
Right. So, I mean, I could put this together and probably sell it, you know, as an indicator salesman for $500 or whatever per package, but we're not into that. Right.
Well, right. And it's not indicators, it's patterns that your brain is behind the pattern. Right.
Right. So with that being said, we're at our time. I hope you guys have all enjoyed it. Those of you on YouTube, give us a like and, you know, your comments, and, you know, take a trial to our room, join us, and Dan and I are here to help you get to where we are today.
All right. Happy trading, everybody. Have a great week.
All right. Have a good one.
See you next Wednesday.